Right. Hello. What's going on, guys? Thank you, Investor Inspiration, for throwing me on. I'm very happy and honored to be a part of this community. I was looking at some of the archived, and you guys have some, some game changers. I mean, the fact that you have Levette Brothers coming up later on today. I mean, that was definitely one of the guys that I found online to be somebody of an inspiration for my success as well. So I mean, they have a very comprehensive training, and they do very, very well. But so to go into myself, hello, my name's Cleveland Bishop. I'm 25 years old. I come out of Atlanta, Georgia. I went to Georgia State University, as she mentioned, and I got my start in FX in 2010. So I have a couple of key points here that I want to run through and kind of let you guys know where I came from, give you a little bit of background about myself and all of that. So I first found out about trading because of Circuit City. So I guess I was around 18, 19 years old. Went downstairs, and then I saw my dad. He had his hands in his lap, and I was like, Dad, what's going on? His head in his lap. I was like, what's going on? He was looking pretty sad, and he mentioned, he was like, man, I bought Circuit City, and I'm like, what do you mean? We have a Circuit City? Like, what are you talking about? And then he mentioned, he was like, no, I bought the stock Circuit City, and then he went to explain the stock market to me, and then I was like, well, shit, why'd you buy Circuit City? You should have bought Best Buy, right? And then he was like, oh, okay, well, what else should I have bought, right? And then we know Circuit City ended up going bankrupt maybe about 2 or 3 months after that. And then I proceeded to kind of, help my dad, and he kind of would ask me, so what kind of stuff are you into? And off of that, he got a Netflix pretty early. He got an Apple pretty early. He was a little late in Amazon, but then Amazon kind of killed off on their R&D, and now they're at all-time highs. So he got into a couple of good positions early, and it changed our lifestyle. I saw how the stock market could affect you in such a way that you can really have not only just a part-time stream of income. It can absolutely replace it. But there's a couple of things that kind of have to happen before that ever comes to fruition, right? So went over to Georgia State University. First, immediately took up finance, and got very, very involved in the finance community there. There's a society called the Trader Society. Was part of the Trader Society. Ended up become head of the portfolio management of Georgia State. I managed a $250,000 portfolio, real capital. And it was more of an investing style. So, I mean, we were holding positions, a quarter, months and months at a time. And we were actually averaging around 8% a quarter, and, if you're investing, that's not so bad, right? That's pretty good. But then started to realize that, hey, look, this isn't as fun and as fruitful as I thought it would be. You need an immense amount of capital, to really be able to benefit from an 8% push. What can I do, and what is there for me to be able to execute in the same arena of capital management, but on a shorter time scale? Because I understood that, hey, look, can you make percentages in a day, percentages in a week? And then I came across day trading by doing a little bit of research. Got involved in the Chicago Mercantile Exchange trading competition. You guys can look them up. I'm sure you guys all know who the CME is. It's the second largest exchange in the United States. And I think one of the largest exchanges in the world. And we got demo capital, around $100,000 demo capital, and over 2 weeks, grew the portfolio to $170,000. And what we were using was just a simple mean divergence strategy. So I was just trading breakouts. If you go back and look at 2014, 2013, on the S&P 500, you can kind of see why we probably did so good. The S&P 500 was just, it was skyrocketing at the time. And then, as you guys know now, it flatlined for around 2 years, 2015, 2016, but that's not when I was in. So got picked up by a firm soon thereafter. Didn't really like that so much because I really went back into the same thing that I was doing. The firm was more structured in terms of order flow. So I was really just looking at a bunch of numbers. The charts are really off the screen. You guys will be surprised. On the institutional investor front, retail traders are really some of the only guys that are honestly looking at charts, looking at price action and things of that sort. On a higher level, there's a little bit less risk involved. And so the business model is a little different. You're more you're a liquidity provider. Okay. You're taking trades for clientele, things of that sort. All right. So as a retail trader, you have to understand you're at the bottom end. All right. We're going to go a little bit deeper into that, but you have all the risk. Okay. You're managing the capital on your own. It's a very, very, very challenging thing to do. Okay. And it seems to be easy, but doesn't everything, right? There's a reason why so many traders fail, 90, 95%. And you know, again, it's because the conceptualization of how to execute, it's very hard to get there. But once you build a foundation, some of the things that we're going to go into, you can scale extremely well. Okay, so my trading style: intra-week swing trading and day trading. Okay, so I usually don't like to hold positions over the course of over the weekend. You know, there's just seems to be a lot of different turmoil and things that can happen over the weekend. A prime example is we can go look at the Euro USD, and when Trump didn't pass the healthcare bill, boom, you know, we get a 50 pip gap to the upside. You could have perceived that market to be overextended before that happened, but then news comes into play, and then the whole market has to readjust, right? So I find there's a little bit less risk when I'm holding positions intra-week. Now, do I do that 100% of the time? No, sometimes I can't hold over the weekend, but you know, it's what I try to stay away from. So my edge, I quantify my edge as to I look for liquidity, sentiment, volatility, and momentum. Okay, if you don't have an edge, we're going to get into that. Then you don't really, I'm sure you're not profitable. Anybody that is profitable can say, this is why I make money, and they won't start talking a bunch of technical analysis jargon. All right, technical analysis is on top of the foreign exchange market. It is not the foreign exchange market. Okay, it's not the currency market. Any market you're in, technical analysis sits on top of that. All right, and if you don't understand the underlying, you're screwed, right? I mean, you're going to be in trouble. Okay, so my job on an intraday basis is to spot short-term market participants and trade the market inefficiencies they leave in their wake. All right, so think about it like this: if you can spot short-term market money coming into the marketplace, okay, well then what's going to happen? Well, when short-term market money enters the market, then it usually leaves the market. Okay, so you can quantify that as a retracement. And if you open up your charts in your broker, and it's 6 o'clock in the morning, or it's 3 a.m. depending on what session you're trading, and you see that there hasn't been much volatility, then what can you assume? Hey, look, we still have an opportunity to execute in a direction, in our directional bias. Okay, so if you don't see the market money, if you don't see the short-term market money as of yet, then you have a chance. If you see it, then hopefully you can pull the retracement of them actually exiting the market, as the time goes along and as the days go along. Okay, so if you guys want to contact me, you can contact me at Cleveland@motivefx.com, and I'm excited to start off on the webinar. First things we're gonna start off with is an understanding of the asset class we're in. Okay, so this is about the 4 quintessential rules of discretionary trading. All right, so you have the asset class Forex Foundation. Okay, you have creating a methodology, a systematic framework built on top of a comprehensive understanding of your foundation. It's so important that you understand the underlying, because then you create a strategy, and then guess what? You think your strategy isn't working, and then you try to fix the strategy. All right, you try to fix the strategy, you try to compensate for your lack of understanding of the foundation by trying to fix your strategy. Okay, once you understand the foundation, it's not so much you're fixing your strategy in terms of technical analysis and confluence and all those things. You're more or less learning more about the foundational elements of the market: price behavior, price delivery, price structure, and all of that. All right, and then so once you build a comprehensive methodology, then what do? Okay, you have a trading methodology. You say to yourself, okay, my trading methodology, I'm a breakout trader. It kicks off around 65% of the time. All right, I can expect this much in terms of gross pips I can make, gross pips I can lose, blah, blah, blah. You maybe figure this all out on the demo account. You then have to start applying risks to it. Okay, and capital management. I mean, that's what that is: a solid understanding of how to manage money, risk as a business. Okay, so the most pertinent aspect of this business is understanding how to manage money, is the preservation of capital, and that's something we're going to go into. Okay, and then we're going to briefly touch on the psychology, value money, and the psychological state in the current market. All right, so we know the market's based on fear and greed. It is extremely important, all right, to understand that state. Just like you risk money and just how you are adverse and afraid of losing it, the same amount of the same people that are controlling this market. You have Deutsche Bank traders. Okay, you have Virtue Capital traders. Okay, I was just at the exchange about 2 weeks ago, met up with some of the specialists on Virtue Capital, and again they were mentioning to me they're very risk averse. They are very afraid of losing money. That's the business they're in. All right, so guess what that means, folks? You're going to see those moves. All right, if you're looking to liquidate, and if you understand the psychological state of the market, then you're going to understand how those market participants are trading, and you're going to understand when they have a high level of risk adversity, because guess what's going to happen? You're going to see liquidation. Okay, where there's a lot of greed and where there's a lot of fear, and where there's an in-between. You don't want to be in the middle where someone's like, I don't really know what's going to happen, let's see how it plays out. You want to be on the extremes of the market, because that's where you're going to catch your best entries. All right, so we're going to go deeper into my methodology and what I do, but again, this is really more of just I'm not the guy to dive straight into the charts. Okay. An analogy I love to use is, would you create a chess strategy if you don't know how to play chess? Okay. I'm not going to show you a bunch of technical analysis and all that kind of stuff. And if that's what you think, I'm going to do, then I'm going to disappoint you. I'm going to help you hone in on this business model. I'm going to help you hone in on how to cultivate a sustainable, tradable, and consistent business model where you can rely on, some expectancy month to month. Okay. So we're going to push over. We're going to start with the Forex Foundation. Now, it's very simple at first, right? I mean, the currency market structure, right? You have a retail broker, you have currency pairs, miners, and all these kind of things, okay? So you have the foundational elements of the market that you really just understand and everyone can kind of get to know within a couple of days, all right? So what comes a little bit deeper after that is you have market participation, right? So you have central banks, hedge funds. You need to know how these guys are trading capital because, again, they are controlling the marketplace, right? So at the end of the day, if you have some kind of central bank intervention, or if you have some kind of hedge funds and, some a high level of speculation going on, you want to have an idea as to what these guys are thinking, okay? And then you have us at the end as retail traders. All right, so I do trade capital for Aloma, so I'm not technically a retail trader, but most of my time is been spent in the retail trader market and really trying to, again, analyze risk and look for the best reward potentials that I can. Okay, so you have to cultivate a very powerful foundation. I'm going to push over into the charts in a second so I can kind of show you guys exactly how you're going to just really build on top of that beginning structure. All right, so in terms of understanding the foundation, you start here, you start with your brokerage. It's nothing too complex, right? I mean, at the end of the day, you really try to understand it. You're looking at the charts, you're trying to understand time frames. Okay, right now I have up, this is Thinkorswim. They have a really great platform over at TD Ameritrade. And what you're trying to understand is you're trying to understand the time frames, you understand what candlesticks are, right? I mean, if you start diving directly into why price moves, you're gonna, you're in a little bit of a, you're in a little bit of a problem. It's very dangerous to try to go straight into the understanding of that. You want to start with, price. You want to start with time scales. Okay, you want to start with the understanding of, maybe what's going on, fundamentally around the market. Who's trading in this marketplace? Why does this market even exist? Okay, so again, if you don't have a solid foundation, it's going to be hard for you to scale very, very well. All right, so after you have that solid understanding, this is where I'm going to spend most of my time in the foundation. You really need to understand the sentiment, the liquidity, volatility, and momentum. Okay, now this is what I base my trading around, and it hasn't changed since I've gotten in the business. So since 2011, around 2011, spring 2011, I was really focused in understanding why the market did what it did and, how I could take advantage of that. Because this is where your edge is. Your edge isn't found in understanding technical analysis, and placing different fibs and, candlestick patterns. That's not where your edge lies. Okay, that's not quantifiable enough. That's called descriptive. Okay, that's descriptive. You don't want to be describing the market. You want to be predicting it. Okay, you want to build a predictive methodology. We're going to go deeper over that in the methodology. And you do that by understanding market movement itself. Okay, so we're going to start off with sentiment. And we're going to move a little bit further along, okay? So if I pull back over into the charts, you guys have to have an idea of what sentiment is, okay? So sentiment is the overall idea of where these markets are going to go. So you find sentiment by understanding the fundamentals. You find sentiment by understanding trade flows. You find sentiment by understanding cash flows. It's very important that you have an idea as to what's going on and what these investors are thinking, okay? So now let me ask you, do you find sentiment on a 1 minute time frame? All right, is there price? Are there institutional traders and traders saying buy here, sell here, buy there, sell here, buy there? No, that's not what's happening. Okay, we understand that this is probably liquidity, and these are liquidity issues going on in the market. Okay, so where do you find sentiment? Well, you find sentiment on your higher time frames. If I pull over into the monthly time frame, you can have all the technical analysis you want, but technical analysis isn't going to let you know that the euro is about to sell off, for 3,000 pips. Okay, that's not what technical analysis is for. You got to think. I'm sure you guys seen The Big Short. Okay, and if you haven't, go check it out. It's a great movie. The guy who was running the firm, guess what? He had fundamental data. He had information that people didn't know. Okay, and it's all about who has that data, and it's all about, okay, what are people going to do with that data? What are the investors going to do with that data? Because if you understand how they are positioned in the market and what their ideals are, then guess what's going to happen, folks? you're going to get some movement. Okay, so we obviously see technical analysis is not the basis. Okay, and understanding technical analysis is not the basis on these higher time frames. You want to know what's going on, you know, with those higher institutions and what they're thinking. All right, so if I pull over a little bit more, you go here. So again, what are investors doing? Investors, they're looking at fundamental data that tells them the future value of an asset will appreciate or depreciate. All right, so let's go a little bit deeper and let's look at Trump's election and let's talk about that. Okay, so right here we have November. Okay, so if I pull over a bit, this is where we're trading. We're trading in this price range. Okay, so we all know the euro's been trading in this price range for around 2 years, and nothing changed up until the Trump election. Okay, now we all know what Donald Trump's press ideals were. We all know what he was, what he was getting his voters for: economic reform, right? A strong dollar, lots of, there was lots of political unrest because he was cutting ties with all these other, economies to, bring more jobs back to our economy, and you can, ask yourself if he's doing that or not. But at the end of the day, investors and market participants are looking at that information that Trump is giving. Technically, what he was spewing in that time was data, right? He was basically saying, hey, look, if I'm elected president, the US dollar is about to get a lot stronger. Okay, so guess what happens? It was a surprise, right? There was a surprise in the market. Trump gets elected, and then boom, what do you get? You get a sell-off. Now think about this. Trump didn't do anything yet. He wasn't until office until the January 20th. So why do we get such an immense sell-off? Investors are understanding and seeing that, oh crap, Trump is in the office. What do we need to do? We need to start positioning ourselves to be ahead of the curve. Once he starts enacting these policy reforms, guess what, folks? It's going to make the US dollar get a lot stronger. So you had investors do what? You had investors more inclined to hop into this market and to start shorting the euro dollar based off of what sentiment, based off of the fundamental data that was coming in. Okay, so if you don't have any idea of what's happening fundamentally and you're swing trading, you're definitely going to get caught up. I can't say that technical analysis and your Fibonacci's are going to give you are going to allow you to know that the euro is going to sell off for 500 pips. Okay, it just doesn't work like that. All right, so what you need to do is you need to have an idea and you need to do the best you can to be to conceptualizing the fundamental data, and then allow that to come in and allow that to play a role in your business, especially if you're on a swing trading time frame. Now, if you're looking at the 1 minute and the 5 minute, and that's the maybe the hourly is the highest you go because you're just trading liquidity, you're trading that short-term market participation, then I wouldn't say that policy reform and macro events need to be that relevant to what's going on. But if you're looking at the 4-hour time frame, the daily time frame, then it is imperative that obviously. All right, I mean, how much information do you need? You need this. I mean, do you need to see anything else, right? So if we pull on over, what happened in December? Okay, so in December we raised rates another 25 basis points. So what did that do, guys? That gave us another push to the sell side. Okay, now something interesting happened around January, and I was talking about this to my trader team in January. You can go back and watch some of my videos. I'll pull up my YouTube, and you guys can go back and go into January and see exactly what I was saying. The Trump politics and the Trump trade, so to speak, and the economic reform wasn't really panning out so well. Okay, there wasn't really any kind of data coming out that he was going to do what he was screaming about the entire election. Okay, remember, the markets were like this because we weren't expecting Trump to win the election. Okay, but then if we were expecting Trump to win the election, trust me, you would have saw a downside move in this euro dollar a lot sooner. But since it was unexpected, it had to hurriedly get there. All right. And so what happened once people realized that, hey, look, they may his administration may not have things panned out the way they made it seem. The same investors and the same capital that was put inside of this down move to take advantage of that perceived data that was supposedly going to strengthen the US dollar, since it wasn't coming out, it was being liquidated. People were repositioning, and these larger institutions were repositioning to do what? To understand that, hey, look, we are now at risk because we're so short euro dollar, we're so long US dollar, Trump isn't doing anything. Let's take a little risk off the table. Let's allow some of the stuff that he's mentioning to pan out and see what happens. So you see this market start to come back because he hasn't enacted any kind of economic reform. Now, Republican or Democrat, you have to agree that the market and the investors had that ideal. Okay, you may have all the faith in Trump you want, but that's not enough. Okay, that's not enough. You have to he has to be putting something out there that is going to give investors and give market participants hope that the US dollar is going to become stronger. There has to be true regulation passed. Okay, so then what happens? We eventually come all the way back up into structure here at that interest rate hike, and then since then, as you know, we've been range bound. Okay, so what's kind of coming in the case? So you have different things fundamentally that have come out every now and then to kind of give us an inclination that, hey, maybe he's going to come back. So this was the week where he was talking about tax reform. He finally mentioned something. So you finally see some strength coming back in US dollar. But what was also happening here was you saw political unrest over in the European Union, right? So you saw Marie Le Pen kind of doing well in the polls, a breakdown of the European Union, Brexit just happened and Marie Le Pen may be the new Frexit, all that kind of stuff. Scotland, was exiting the GU to be back into the European Union. There was a lot of stuff going on over here. And guess what, guys? That gave unrest in Europe. Trump was talking about tax reform. You see strength come back. Okay, but then again, folks, the market can only take so much jawboning, right? Jawboning is when politicians and people in some kind of leadership power, kind of control the market a bit just with words. Okay, this was Trump words, and this is people realizing that he's not saying anything that really gives us an idea of what's going on. More words, and then the market stops listening to that, and you're going to see that. In the next couple of weeks. Right now we're in February, early February. You're going to see that in the next couple of weeks here, where you get to see that, hey, look, people are going to stop listening to what the politicians are saying and you're going to look more at the economics. Okay, I mean, investors on the highest level are doing the exact same thing. Okay, so if we pull over, we come down, we rest on structure. You can start up, you can have your fibs and you can use Fibonacci's, you can use technical analysis for entries. But remember, folks, that's not where your edge is. Your edge is understanding the state of the market. And once you understand the state of the market, then precision comes with the methodology. And we're going to be going over that a little bit later. But your methodology is where you have precision. Okay, the fundamentals, the FX Foundation is where you understand market movement. All right, so you want to have an idea of sentiment and you want to have an idea of how these markets are reacting and how these markets are moving. Okay, so as you guys know, boom, we've kind of come along a bit, and now again we're somewhat range bound. Now notice this: what broke us out of this range here? Okay, usually you don't get breaks out of ranges. Okay, especially on a daily or weekly time scale, unless something does it, unless something economically does it. Okay, Trump didn't pass a bill, we get a gap. Technical analysis can't predict gaps. Okay, it just doesn't work like that. But enormous, ground-shaking, political, fundamental, oil, all these different things that commodity-based, everything involving these economies that is about the true infrastructure of the market, that can create gaps, okay? And so if you can calculate and have an idea, wow, Trump didn't pass his bill, what should you do? You should look at the current state of the market. That's enormous news, okay? I mean, that's one of the first legislations, that's the first bill of legislation that wasn't passed. That's very precedent as to how this presidency is gonna go along. Okay, so I'm not really into politics. I don't, I want Trump to do well because I'm an American, right? So I don't care what he does. I just want him to, have a good faith and, a good precedent in making sure we're okay. But I have to look at the market and I have to come back and say, hey, look, he didn't do what he says he's going to execute and how he's going to execute. We could probably trade that. Okay, so you can trade a lot of these instances. You can trade a lot of things that these politicians and things are doing, but you want to have an idea as to market structure and things of that sort. So if I go deeper into the 4-hour time frame, I want to show you guys something. Right here, you have Draghi speaking, okay? So earlier in March, Draghi was speaking, and Draghi spoke about how, there potentially isn't a need for too much more QE. As we know that right now, I think they're printing out about $80 million monthly. Well, they want to decrease it to 60 million, and they want to potentially start getting their interest rates out of the negative. So right now it's at negative 40 basis points. He mentioned that there could be a turning point, that the economy is stabling. Okay, so immediately you see what? You see strength come back. That was a surprise. People weren't really expecting that to happen. All right, so if you have just an inclination and an idea as to what's going on with these with the speeches, the FOC meetings, and have a and you're not trading the news. You're not looking at the news and saying, oh, that's what they said. Trade. You want to have a idea of what's going on in the current state and the positioning of the market, and then you can say, wow, that is going to have an impact, and it's going to potentially have a negative or some kind of impact on the market. If I can look at the current state of the market, we may be able to trade that. And so I'm not saying that you can just trade the news, because it's not just about, hey, look, we're going to have some kind of news. We're going to have some news come out. If it's good or bad, let's short it. If it's good, news for the US dollar, let's short the euro. If it's bad news for the US dollar, let's buy the euro. It doesn't work like that. On this time frame, on the 4-hour and on the daily, there's another issue, and that's liquidity issues, and we're going to go deeper into that. Okay, so you have to kind of build everything together, and that's what I did. You know, when I came to the idea that, you know, sentiment, liquidity, volatility, and momentum combined can give you an amazing edge if you understand the current state of those instruments there. So again, we fold on over. We've come, you know, I think you guys get the idea that sentiment is extremely important. And notice we've been range bound here for quite some time. So what do we have tomorrow? Right, we have NFP. NFP is going to be the catalyst that breaks us out of this range, whether that's to the downside or whether that's to the upside. Okay, I was mentioning yesterday to one of my members that I work with that, look, man, it's not really about the good number or the bad number of NFP. It's about the current positioning of the market. Okay, if the market is overextended in some direction, then it's very important for you to understand that, hey, look, the market may be positioned in such a way that it doesn't really matter what the NFP number is about. Okay, and you may say, well, that's not true. Well, then I'm going to ask you, then why did we see a 120 pip push to the upside on this euro dollar when we raised interest rates? Okay, so you have to ask yourself, what's actually going on here? And you know, is everything about good and bad numbers? Because it's truly not. And if it is, then I'm not. Then again, people would already be, you know, trillionaires. If you could just guess, hey, good NFP numbers, let's sell the market off. Then immediately you'd always, where's everybody at? Where's all the people, you know, having 100% accuracy on NFP? There's obviously some kind of disconnect, and I think it's more than volatility. I don't think it's volatility just shaking everybody out of the market so they don't have a chance to make money. It's something more than that, and it's the positioning of the market, and it's that speculation that, hey, look, is this market in a state of, you know, is this market in a low liquid state to the buy side? You know, is there a lack of buyers down here that have yet been able to push it out of these 06 highs, you know, back up into the range? Because you would assume, hey, large retracement, we should potentially be getting a pullback. Okay, I mean, that's why I had this drawn up here, probably going over a couple of things the other day. But at the end of the day, you really just don't know what their ideas are as to what to do with this market. Okay, so you have to have that in mind. Okay, so that's sentiment. You know, that's sentiment at its best, folks. Sentiment can give you an idea in the positioning of the market on these higher time frames, and it can allow you to understand the directional bias. You know, that's something I actually didn't touch on. Directional bias is just that. It's an idea as to where the market's going to go directionally based on the fundamentals. Okay, now should you go just based off of the fundamentals? No, you shouldn't. And then we're going to go into that, but it definitely has an impact, obviously. Okay, so moving on over, you have sentiment, and I want to get into liquidity, volatility, and momentum, but we'll start off with a little bit of liquidity. Okay, so I have a million metaphors for this. I have a million metaphors to kind of help me conceptualize liquidity, and that's what I'm going to be pitching to you guys, you know, exactly what liquidity is, because it's kind of hard to understand. No one really talks about this kind of stuff. Everyone kind of just goes straight into technical analysis. And again, it's like I honestly see that everyone's already doing technical analysis, but they're not making any money. So people need to be stop talking about technicals and start talking about a little bit more of the underlying. Okay. So I'm going to ask you guys, I'm going to set the stage here and kind of paint a nice little picture for you guys in terms of liquidity. All right. So let's say there's a room filled, okay, a warehouse, an empty warehouse filled of, you know, 1,000 people, and there's buying and selling going on. Okay. Let's say they're buying and selling gold, right? So, and let's say there's, you know, hundreds of monitors lining the top of the warehouse, just bringing in data. So a lot of these people, they love gold. They're all into gold. And they want to find good pricing for it. And let's say some data comes in, you know, on those monitors that give them some information about gold and gives them some information about where gold's going. All right, let's say Trump gets impeached. Let's say the European Union breaks apart. What's going to happen, folks? All right, people are going to escape to the, you know, the most stable, I guess you can call it, currency that has ever existed, which is gold, right? So you're going to have an immense buying of gold, okay? But let's say in that warehouse, everyone buys gold. So if everyone buys gold, then guess what? There's a liquidity issue there, right? So let's perceive this move right here as those market participants buying gold, okay? Everyone buys gold, and now at this point, no one's there left to buy, okay? Now the market's just hanging up here at these highs, and you have some investors that are potentially in profit, and then you have some that got in last, right? I mean, these are the guys that are kind of hoping for this thing to come from, you know, it's right now, let's say gold is at, you know, $1,000 an ounce. They want it to go to 1,200. Okay, so they're sitting there thinking, oh damn, why isn't this running? Okay, So then let's say some reform happens. Okay, let's say we get a new president, the European Union comes back together, and all this money starts going back into the currency markets, right? What's going to start to happen in that case? You're going to start to have people that were so, forensically buying gold. You're going to start to have a little bit of doubt that gold is going to be able to maintain its value. There are going to be investors that are going to be looking to start to short gold because the monetary system is coming back together. So initially, what are you going to get? You're going to get liquidity to the other side. Okay, so you're going to now have the market positioning themselves from a buying sentiment, okay, to a selling sentiment. So we're going into sentiment, but remember, we're talking about the liquidity issue. There's no one else left to buy. You know, if this market is ran by banks, and last time I checked, folks, banks don't theoretically print money. Okay, and so since they don't print money, if there is an extreme amount of short-term market participation, or even medium-term market participation long in a certain asset, there's a rebalancing that has to happen, and you see that happening. Okay, the market can't just rip, you know, a certain amount of pips in any given day or any given week, especially without some kind of fundamental implication. And if there aren't really that, you know, monstrously big fundamental implications that have come out about a certain assets, about a certain currency pair, then guess what, folks? You can deem the market to be overextended based off of the fact that, hey, look, there's a rebalancing that has to happen. The market has to come back into a tradable area because no one's going to be up here buying at these 07 levels, or at, you know, we're coming back over into the real world here. No one's going to be buying at these 07 levels because, again, there isn't data to support the buying here. If you're an institution and you saw that literally just a couple of days ago, the market was 130 points away from where it is currently, what are you going to do? All right, you're going to understand that while some of these institutions that are in that move, they're going to be looking to liquidate and take profit, or I'm going to be deeming this market up here as overvalued. Okay, so another metaphor I like to use is, would you buy an expensive shirt? All right, if you saw that, would you buy a shirt for $100? Okay. You probably wouldn't. At least a normal person wouldn't. Why? Because you know that shirts go for $5, shirts go for $10. Okay, you use historical price to understand exactly how expensive or cheap something is. Okay, now would you sell a $500 shirt if the market was there for it? You know, and you saw that. And you saw that previously, you know, shirts have skyrocketed, and now, you know, you have a potential to actually profit off of, you know, a shirt that was going for $100. It's now going at $500. Absolutely, you would sell an expensive shirt at that price point, okay? Because again, the market values it very high. If you bought it at a low price point, then you're more inclined to sell it at that higher price point, okay? But you need some bang for your buck. So in this sense, you know, it's hard to kind of convert that over in the real world in terms of shirts, but in terms of currencies, if you see that something's expensive and that it isn't likely to be bought, then guess what's probably going to happen? You're probably going to get a retracement. So anyway, folks, just to wrap things up on that idea, remember what your job is to do as a trader, okay, as a discretionary trader. Your job is to find value, all right, and you find those values at an extreme. Remember, there's no edge and there's no real say in value in the middle. Okay, you either want to buy something that's extremely expensive, okay, you want to buy something that's dirt cheap. But whenever you play in the middle, it's very dangerous, okay? So an idea of that, and where you guys can really understand that, is let's go back, and I want to go back and I want you guys to come check out a range here that would potentially be happening on the Aussie, but those are actually a really nice range on the pound. And I want to help you guys hone in on exactly what that means as to, you know, buying things expensive or cheap or something right there. All right. So if we zoom if we zoom close in to this price point here, anytime the market is kind of right here in the middle, it's always harder to quantify an up or down movement, you know, if the market's sitting right there in the middle of structure. Okay. So you don't ever want to do that. Think about it. No one wants to buy the market in the middle of structure. People want to buy it at the tops or at the bottoms. Okay. So basically that's, you know, yeah, you can say that's support and resistance, and that's awesome because it is. Okay, it is. But remember, you want to have an idea as to what that top and what that bottom actually means. All right. And so technical analysis, it can give you an edge, and it can allow you to be able to find that kind of find those kinds of instances. Okay. I mean, Fibonacci's and Fibonacci ratios are really good for that. But, you know, first things first, you want to have an idea as to what the current state is in for that market. And, you know, this isn't a thing where you're really asking yourself and digging deep, okay, where's my sentiment? What's my liquidity look like? It's not that deep. you're going to get to a point to where you can just look at it and say, okay, well, this market seems to be overextended, or this market really hasn't done too much. What are you going to do with a market that's kind of sitting right there in the middle? Not much. All right. So, I mean, we were trying to put this, trade this euro to go long for the past, 3 or 4 days. Okay. Back up into this range, but nothing has happened. So anybody that's been dabbling in the euro, I bet there's a high likelihood that if you weren't really conserving risk properly or something along those lines, and you were dabbling in this euro dollar, chances are you were losing money. Unless you were buying it at the tops and the bottoms of just a 50 pip range, you were really just kind of going sideways. Okay, so you want to find the market in at its extremes, and on a larger time frame, this market is technically at an extreme. I mean, but if you zero in, it's absolutely not. So there's a patience that you have to have when you're dealing on these larger time frames to allow these things to pan out a bit. Okay, so there are definitely liquidity issues in the market. You have to understand it, you have to comprehend it, and once you understand market liquidity and how market liquidity can affect you, you can scale very well. So one thing I wanted to go deeper into is the market inefficiencies. Okay, and so that's basically what comes about when you have a liquidity issue. Okay, you have a market inefficiency. So there's just a really great example here in this euro dollar. Okay, so when this market pushes up and we see market run 120 points. Okay, now what happened up here at this high? Okay, the market, not only was it very momentous, which is one of our 4 factors to determining a direction for having a directional bias, sentiment, liquidity, volatility, momentum, we see a very momentous move up in the structure. Okay, now this is intraday momentum. This is on a 4-hour time frame. All right, and so what has to happen at this point for this market to continue pushing and up to the upside on this euro dollar? Okay, there has to be a rebalancing. The institutions and the firms that are long in this euro dollar right now, they have to rebalance, and they have to put themselves in a position to where, there's a more effective price. And it's obviously not up here at the 0620s. Okay, would you buy up here? Absolutely not. So any place where there's a horrible time to buy, it's a really great time to sell. Okay, I had an issue with that earlier this week. I was saying to my team, guys, do not buy at these 0680s. It's a horrible place to buy. And then we saw it push 40 points to the sell side. And then I go back and I say to myself, well, I should have sold right there. I was just in such a buying mindset. I knew where not to buy, but I should have known that, hey, look, that's probably a great place to start to sell. Okay, so you have a lot of momentum up into a certain move. Okay, now remember what momentum is. Momentum is time and price, and it's factored in, right? So it's the amount of time, it's the amount of how high price goes in a certain amount of time. Okay, so if you see price move 50 pips in 10, 12, 13, 14 hours, then guess what? There's not a lot of momentum, right? But if you see price move 120 pips, okay, in a span of just 8, 9, 10 hours, then that's fairly momentous. That's out of the norm. Okay, and so you find yourself now probably at an extreme. Any kind of irregularity in price probably puts you at some kind of extreme. And if you understand the overall price dynamic, then now you're effectively really kind of able to put the market in a place where you say, hey, look, probabilistically, this market has to turn over. Why? Based off of a number of factors. Momentum came in from a very low price level. So now what's happening down here at these levels? You had investors getting down here. You had investors getting down here. You had investors getting down here. Okay, investors are getting in these markets all the way down here at these lows. That's important to you because think about it. Where are they most likely to take profit? At certain structural areas. Okay, remember the t-shirt example, we look at historical prices to determine value. So if we look at historical prices here, we see that, hey, look, there was at one point the market was coined as expensive up here at these highs. We call that support, right? We call that resistance. All right. So we see a price level where the market says, hey, expensive. Okay. It has not gone outside of this level. There is no history up here. Okay. So now what's happening, since there's no history, those market participants are like, they don't want to risk a breakout. Breakouts are risky because now you're basically saying that the market has completely shifted in its ideals and has come to and is at a point where it says, no, value exceeds this level now. Even though historically I don't see that, value exceeds this level now because of this new information that we have, or based off of these new number of factors. Okay, so all these market participants, aren't they likely to take profit? I mean, if you got in down here at the 05 teens, okay, and you see the market up here at the 06 teens, okay, as an investor and as a short-term market participant, all right, these large institutions, just like how you are looking at, certain time frames and looking at capitalize and maximize profits intraday and intra-week, folks, there are extremely large institutions, very, very well capitalized, doing the exact same thing. Okay, so what's happening? They're looking at this price point. They're saying, hey, look, guys, they feel as if what? They've maximized profits. Those institutions will slowly start to liquidate. All right, and then where do you see this market come back down into? Okay, so there's something called the apex of a move, or honestly, where the move, delete all these things here, honestly, where the move kind of found its original price point, where the move kind of found its original value. You see value come all the way back down to where you see the initial push outside of the range. Okay, so now at this point, what do you have? You have these market participants that say to themselves, hey, look, we're now back down here, back down here at the 0530s, mid 05s, and guess what, folks? This made a lower high, right? So think about what a lower high is now, in a sense. Okay, if every single dollar that went into this move came out of this move, that would have been a 100% retracement, right? But the fact that we have a lower high here, what does that mean? That means that there's still somebody in this move here that is still in the market. So their idea is probably to take the market. Okay, they have a little bit more risk on the table, or a little bit more patience, or they're just a different trading style that is going to allow them to understand that, hey, look, we're going to find value potentially all the way up here at these highs. Okay, so you have to ask yourself, there's an amount of speculation, there's an amount of sentiment, you know, in every single move. If the move was 100% speculatory, folks, you would have saw a move go all the way up and all the way down, because speculation doesn't care to hold trades for months and months and months, right? I mean, are you guys trying to wait for the next interest rate hike, which has a 70% chance in June, to really kind of price in and say, hey, look, guys, we're gonna have another interest rate hike. Let's put some money on the books and wait for the next couple of months? No, that's absolutely not what you're doing, right? So you're looking to take profit intraday, intra-week, you know, potentially at least within the month, right? So at the end of the day, what that means for you folks is you're gonna be in the market and you're gonna be out of the market. Okay, and that's what my job is to do every day. Remember, I spot short-term market participation. If I can see that there's a heavy amount of speculation in the marketplace, then guess what? Speculation is just like me. Speculation is just like you. Okay, they want to be in, they want to maximize profits, and any chance that they think the market's going to go against them, they are out. All right, and so we see that we had a heavy amount of speculation in this previous move here, and we had liquidity issues, and we didn't start to find value and buy side participation back down up until the 0532s. But guess what? This move allowed to happen here. Okay, probably with a little bit of sentiment to help it get pushed out. All right, so what happened in this case is price discovery. All right, so we see this move right here. I want you guys to just focus on this there. Okay, now remember what price discovery is. Okay, price discovery is basically when you have market participants in certain ranges and in certain price areas. Okay, the market's very readily and easy to go back into that area. All right, so you see the market range, and it does very well with sitting in ranges, and you see it come and finds little price areas. Price discovery is very easy in a range. So anytime you have a market that is sold off, you allow the market to push back up into that range, you know, honestly without a problem. You're going to have buy side participation at this level. You're going to have sell side participation at this level. You're going to find that very frequently. Okay, but what happens when you push out of the range? When you push out of the range, there will be an imbalancing that's going to happen. Okay, and so then usually when you push out of a range, you see immense moves, and that's the breakout that everybody kind of talks about. So you can say, oh, breakouts, you know, yeah, the market broke out. But if you don't have an idea as to, you know, the nuances of a breakout and understanding a breakout, then you're going to be at a disadvantage. Okay, so one problem with this breakout, it's a good breakout. I mean, it pushed up quite a bit. It's an 80 pip push outside of the breakout, but there's a problem with it. Okay, now, is this a good price to get in? Okay, you have to ask yourself, because momentum didn't start right here at this breakout. I saw momentum started down here at 0530 at the 0530s, and then we pushed out all the way up to 180 pips to the upside. So if you're trading breakouts, wouldn't you rather see the market consolidate at the high a bit instead of coming in at the lower of the range? That's a horrible breakout. I would never want to take a breakout where the market came in 100 pips and then I'm expecting it to shoot what? You're usually going to get weaker breaks because you're going to have market participants in these levels here that are doing what? They want to take profit. They want to get out of the move. They've already maximized profits potentially. Okay, so in terms of breakouts, you have to understand price structure now, right? Price structure is very important to understanding a breakout, and price discovery is very important to understanding a breakout. You want to catch breakouts. I mean, we'll find a lot of instances. You see the most powerful breaks happen when the market was really kind of sitting at least the high of the range. You could probably coin it as, hey, look, what if this, since you guys love Fibonacci, what if, let's say this is the swing here, what if the market was sitting in this range here? What if the market never broke at 38.2, sat around a bit in this range, gathered some more momentum, accumulated some more shares, got some more participants to come on in on this market, and then break? Then, folks, I'm telling you, you would have saw a stronger move out because we didn't have to come in from such a low. Okay, you would have saw the market come up, you would have saw some market participation leave out. That's what you want to see. I want to see retracements. If the market comes in from such a low, I would love to see a retracement come in. Maybe the market sit there and then push, because at least that means we may be able to find some buyers at this level. Okay, so you want to see some sellers get out, you want to see some people liquidate and get out of the market, and you didn't want to see the market have even more strength and push back out. Because remember, I know a rebalancing has to happen, and I know it's gonna happen, but guess what, folks? If you get in at the rebalancing at the wrong time, then guess what's going to happen? You're not going to be able to really maximize that profit potential. Okay, so you have to understand that price dynamic there. So anyway, where does this market go to? Okay, so we see that the market sits on top of the range. All right, now why did the market sit on top of the range? Now think about it as a guy with an enormous amount of capital, millions of dollars in capital, and you're one of the folks that can actually have some kind of movement in this marketplace. Okay, there's only 41 institutions that are able and strong enough to really have some kind of ground shaking market behavior in FX, okay, outside of central banks. Okay, so you can kind of coin it up as like there's 41 prime banks. Then you do have a lot of institutions, a lot of funds, that can probably give the market a little bit of movement. But if you're one of those major institutions, then guess what's going to happen? You understand that you're probably going to find liquidity, okay, at certain price levels. It's going to be hard to find liquidity up here at these highs. And then the second you start infusing the market with capital, immediately it's going to start to run. Okay, so think about it like this, guys. Let's go back into that room example. Okay, let's say there's 1,000 folks in there, and let's say gold again is at 1,000 per ounce. Well, look, again, wrapping up, the cool thing about all of this is that I have this entire work through this entire model inside of a course on the website called motivefx.com. So this is something that I go over with my pros, but I'm going to be adding this to the rookie course, which is a free course. And so, again, I was going to put this webinar in there, but I actually have it all chopped up and ready to go right here. So if you guys want to learn a little bit more about the methodology aspect of things, about the fundamental aspect of things, sentiment, liquidity, volatility, momentum, and creating methodology, moving over into money management, this is all going to be inside of the motivefx.com course. So you can just shoot over into the site, and then we could absolutely follow up there. And I work very closely with most of the folks inside of the platform. So usually we get on calls. You can contact me directly if you have any kind of questions and things like that.